We saw the global equity markets take a really big hit after the April 1st Liberation Day, only to reverse all of those losses and some of the indices actually sitting here now at record highs. So we're right back to where we were. We're looking at valuations overpriced in our opinion, not just here in the US, but in many of the developed international markets as well. When you look at this chart, it's showing you that the price to earnings multiples, those that are trading at a discount or in the green box, that is specifically your small and mid cap value. But basically, the entire developed market, as well as the US, is sitting here with valuations that are either overpriced or downright expensive. We're looking at multiples back to where we were when we were talking about this complacency entering the market as we came into this year, and we're right back to where we were, but nothing has really changed. Yes, we have some of that uncertainty around trade, the actual headlines behind us, but we don't know how that's going to work out in economic growth. We know it's a tax. What does that mean from a business standpoint? And we do think that companies with profits sitting here at record highs, as well as margins very high, that companies do have the ability to absorb some of these tariffs. But the level at which they will, again, that still is a hurt to companies and their profitability. So what does that mean in the second half of this year? We don't think it's as cut and dry as the markets are showing, sitting here near record highs and valuations extended. So we would be cautious about adding any more into this rally that we've seen. Instead, from a U.S. perspective, make sure that you're in line with your asset allocation. Rebalancing in the middle of a year is always a good thing to evaluate. Rebalance, make sure that some of those areas haven't drifted higher. When you look at international equities, now international equities have done very well. They've led this global market rally that we've seen really since the middle of last year. And there is room. There's room, as you can see in this chart, on a 10-year basis. International equities on the developed side are underperforming U.S. equities, and they've been doing this for quite some time. It's the longest stretch that we've seen really since that dot-com bubble and then leading up to the Great Recession. There is room for this rotation to continue. So if you don't have allocation to developed international equities, diversify outside the U.S. Make sure you have allocation there. These are not only cheap relative to the U.S., they are expensive relative to their own history, but they're cheap compared to the US. So if there's not exposure, you want to make sure that you have exposure there. Rotate out of some of these very expensive US sectors.